Hello, my name is Amen Ghebre, VP of Advisory at Sarwa, and today we're going to be diving into a topic that's both fascinating and often misunderstood. We're talking about options trading. Now, options are one of the most versatile tools in the trading world. They are financial contracts that give you the flexibility to benefit from short-term price movements, potentially boosting returns, but also increasing risk. And that's what makes them so unique. Unlike just buying or selling stocks, can be used to protect your portfolio, generate extra income, or take a focused view on where you think the market is headed. Now, here's why this conversation is so exciting. When you zoom out and look at trading behavior across thousands of transactions, patterns begin to emerge. Some traders use options conservatively, like buying protective puts as a form of insurance against market downturns. Others use them to amplify returns, like selling covered calls on stocks they already own to generate extra income. And then there are those who use options to express a short term view, like buying call options ahead of earnings reports when they think that the stock might jump. To unpack all of this, I'm joined today by Tony Lee, Global Head of Brokerage at Alpaca Securities LLC. How are you doing today, Tony?
I'm great, Eamon. Thanks for having me. I'm very excited for this discussion. Options are very near and dear to my heart. I've had a very long career trading and managing options, so I'm very excited to be part of this conversation to introduce more and more investors to the world of options.
No, the pleasure is all ours, Tony, and I really appreciate you making the time. And I know that the time difference is quite significant, or all the way on the other side of the pond, as they would say, but we do appreciate you joining us today. The name Alpaca sounds familiar. It's because they're our technology partners. They're the ones who make it possible for Sarwa clients to trade the markets. Tony and his team have a very unique bird's eye view of how our clients are using options on the platform. Today, we're going to dig into the strategies that you're using, the goals behind them, and what those behaviors tell us about today's trading environment. So, without further ado, let's start with the basics before we dig deeper into the patterns. Tony, if I may, what are the most common things that you're seeing among Starwa clients when using options on the platform?
So, as I was taking a look at some of the volumes over the past couple of weeks, it's not surprising that most of the volume is weighted towards the call purchasing. I think that if you look at retail investors in general, you see most of the volume kind of towards that call buying area because people are looking for that upside exposure in their investments. The one thing that is a little bit surprising is actually how heavily Sarwa users are leaning towards the call buying side. In the marketplace, you typically see that 2-to-1 ratio of calls versus puts. But for Sarwa users, we've been seeing more of a 4-to-1 ratio calls versus puts. So it really highlights the fact that the users are really looking to put on these positions that give them that upside exposure.
What do you think is driving this? I mean, really, at the end of the day, and obviously, we're looking at it high level. We're not in the minds and hearts of these traders, really, at the end of the day, Tony. But just from high level, from what you see, what do you think is a primary driver for these approaches?
I think that we've definitely had a very strong market over the past 5 years, and as we get new investors coming into the markets and looking for options and ways to utilize options, it's obvious. It's very typical for users to kind of think about, okay, well, how do I currently invest in equities, which is typically buying stocks and not shorting stocks, and they want to see how they can utilize that same investment strategy but using options. So call buying is a very natural way for early investors to get introduced to options trading.
Okay, I see. And I love the fact that you picked up on the wider, macro view right now. You're right. The stock market has reached, all-time highs several times this year. I wonder if that's also influencing the strategies in regards to options.
Yeah, so that is something that I may not recommend, but you definitely see in the marketplace in terms of that FOMO type of reaction of getting into the markets when it's at all-time highs. And, to a certain degree, it could be like a smart strategy to think in that, hey, I don't really want to buy this particular stock at a 10-year high, or I don't want to get into the market when every single month we're seeing new highs being generated. So instead, maybe I'll buy a call option that's a little bit of a cheaper investment to still get the upside exposure. And then if the stock market does come down, you didn't actually buy those stocks at the all-time high. You maybe get an opportunity to buy the stock lower, but at the same time, with that call option, you still did get that upside exposure.
Okay. Okay. Thanks for that, Tony. Are you seeing a lot of diversification amongst different stock, I would say strategies, or are we seeing more concentration?
Well, so when I was taking a look at some of the activity, it was pretty diversified, but heavily weighted, not heavily, but more weighted towards the top five stocks, which included like Tesla, Palantir, Apple, some of these very, we call them retail darlings. So that's not that uncommon when it comes to retail investors to be invested into these type of names. The one thing that I did see though is that there wasn't a lot of activity in broad-based ETFs such as SPYs, which is the S&P 500 ETF. Typically in the market you might see up to 10 to 15% of the overall options volume being weighted towards SPY options. With Sarwa users, we're seeing less than 6% of the overall options volume being weighted towards these broad-based ETFs. So to a certain degree, we're not seeing a lot of diversified macro investing happening when people are trading options. So that is something that investors can start thinking about when using options, because in general, SPY stocks are quite expensive. I think they're maybe close to $500, but using options is a cheaper way to get broad-based macro exposure.
So it's interesting that you mentioned that there's concentration amongst those top five companies, and those are, they're the darlings, as you said, of the market at the moment in time. But typically, when people think options, they associate it with gambling. And gambling doesn't necessarily translate to buying good quality companies as the ones that you've just mentioned. So it's interesting that the fact that that stands out from the research that you've seen. What about strategies that are being overlooked?
So as I mentioned, we're seeing a lot of call buying, not a lot of put buying or put selling, and even less call overwriting, which is a strategy that you see quite commonly in the marketplace. Maybe not as much in the retail investing space, but is something that a lot of investors are using to maximize the yield of their portfolio.
Okay, and maybe if we can just elaborate a little bit more on that. We're talking about these put strategies or these covered call strategies. Maybe we can elaborate a little bit more about what it is, how it works, its uses. I would love to hear a little bit more about that, Tony.
Sure. Okay. So some people call it call overwriting. Some people call it covered calls. But essentially, what it means is you buy an underlying stock and then you sell a call option against those underlying stocks. So typically, you'd have to buy 100 shares of something and then maybe to be able to sell one contract of that same option. And so what this strategy allows you to do, it allows you to have an investment in that security, but then be able to generate some yield in potentially a sideways market by selling the call option. So in this situation, if an investor has a long-term holding or has a core holding, and they do believe that they've had a period of time where the stock has performed very well, but they're a little bit unsure about the performance over the next, let's say, 3, 4, 5, 6 months, but they don't want to sell the stock, they could employ a strategy where they systematically sell call options against that core holding just to generate that extra yield over that period of time where they're a little uncertain of the upside potential.
I see. I see. Now, this sounds very interesting, but it sounds like there's also going to be some trade-offs or limitations when it comes to this, Tony. Maybe we can talk a little bit more about the trade-offs of this strategy.
So the trade-offs are that by employing this call overwrite strategy, you're not really protecting your downside. So you still have the full exposure to the downside because you still own those underlying stock. Also, you are capping the upside potential of any large moves to the upside. So if you sell a call option with a strike price that's 5% above the current spot price, then anything above that 5% upside move, you would be capped on any gains after that because the call would call away your stock. And then there are other risks that are involved with shorting calls, potentially early assignment risk. So there are situations where you're short a call option that you could actually be assigned on that option prior to the expiration. That risk is mitigated when you do a covered call strategy, but it is something that all investors should be aware of.
Okay, fair enough. So you mentioned about capped upside. That's one of the things, and also no full downside protection altogether, and possibility of early assignment. I think those are key concerns that we have here with the strategy itself. Thank you for sharing that, Tony. Maybe I want to highlight a company, Taiwan Semiconductor Manufacturing. Their earnings call is expected in the next couple of weeks. I believe it's 16th of October is when they're going to be announcing their earnings call. Suppose someone had a view on TSM. Let's talk practical, right? What are strategies that one can consider if we want to utilize options for the opportunity of TSM.
So I really like this example because, based on your view or one's view, there are several different ways that someone can approach using options in this situation. So TSM has had a very strong year, to put it lightly, in its stock price. So let's say you were, one of the fortunate ones to have held this stock over the course of this year and has had decent returns. Going into the next earnings, let's say your view is that you're a little bit unsure on whether this next earnings report will perform as well as previous earnings reports, or you believe that some of the upside potential has already been priced in. So you're a little bit unsure about the upside potential with this earnings call. And let's say you're also in a situation where you're considering taking some of your profits on TSM stock. You could employ a strategy where you liquidated a portion of your TSM holdings and then use a portion of those proceeds to purchase upside calls on TSM. So what this allows you to do is it allows you to take profit but not miss out on some of the upside that these earnings may or may not provide.
Okay. So essentially it's another way of hedging, your portfolio really at the end of the day.
Yeah. And then on the flip side, let's say your view is that the stock has had a good run and you're quite confident that any upside potential from this earnings call is limited. So in that situation, you can keep holding your stock because you are a long-time believer in the stock. And you can sell a call option against that stock because you believe that there's not a lot of short-term upside with the next earnings call. If what you believe actually happens, there's a chance that the call options that you had sold will expire out of the money and you would have had like a yield enhancing strategy there.
I see. Now, assuming that the earnings calls on the 16th, what timeline should we be looking at when we're looking at strike price and et cetera?
So given that the strategy that you are looking to employ involves the earnings, you want to pick an expiration date that is at least after the expiration. So if the earnings for TSM is October 16th, you might want to pick October 17th or October 24th, depending on whether you're buying or selling the call option and how much yield you want to spend or receive. And also depending on how aggressive you want to get in terms of either selling a call or buying a call, that will determine which strike price that you should buy or sell. So the higher strike price that you buy or sell, the higher premium that you will either have to spend or collect.
So as opposed to somebody looking a little bit further out, why would that not be advisable? So suppose I'm looking at 24th, maybe 30th, and I'm assuming 30th is a working day. But why would that not be necessarily the right approach to this if you're trying to play the earnings call?
Maybe less optimal to pick an expiration date that's too far out because let's say, for example, your strategy is to actually buy the call option. But since your strategy is driven around the earnings call, if you buy a long-dated option, you are paying a lot of time value for a period of time that does not involve the earnings. So if you buy a 3 months option, you're essentially paying for 2.5 months of time value. You don't really need it for the strategy that you're trying to employ.
Brilliant. I appreciate that, Tony. And look, I want to kind of summarize and wrap this up and with a follow-up question or last question. We've heard the word strategy several times. We haven't heard the word speculation, in this strategy itself. Essentially, it's important to align your goals and with the right strategy to help you achieve them. Now, because at the end of the day, it's not just about trading for the sake of trading, but it's about using the right tools for the right purpose. Now, I want to just go over the different trading strategies that are available with regards to options. Maybe if we can talk about just high level about long calls, long puts, protective puts, cash secured puts, covered calls, and really kind of outlining what they're most useful for.
Sure. And, Amen, I like how you mentioned that. I did mention strategy a lot. And speculation is a type of strategy if you are the type of investor that wants to employ that strategy. And that's why it's important to highlight that when it comes to options trading, there's a strategy for everybody depending on your risk tolerance or your investment goals. So, we mentioned strategy, we don't mention speculation. Speculation in itself is a strategy depending on the type of investor you are. So When it comes to option strategy, there are a lot of different options, and it's an empowering tool if investors get familiar with all of these strategies to be able to enhance their investing goals. So as an example, we've talked about long calls. When it comes to long calls, you can structure the strategy or the trade using different expiration dates, using different strikes, and it can vary depending on how bullish you are on that particular stock. Similarly, with long puts, it is the opposite trade of the long call, where you actually want to bet or invest in the downside of a stock's performance, or can be used as a protective put to when you actually hold the stock, or let's say you have a diversified portfolio, you can buy an ETF to be able to protect your overall portfolio for a period of time during times of volatility or times of uncertainty.
Appreciate that.
And then the fourth one we can talk about is cash secured puts. This is essentially a strategy that we do see a lot of people employ in the marketplace, where they like to buy the dip. So every time the market goes down, they look to buy a little bit more into the market. So cash secured puts allows you to employ that strategy using options. So let's say you have a particular stock that you like to buy every time it goes down a certain percentage. You can actually sell puts on that stock. So every single time that stock does go down, you would be assigned on that put, and you would buy that stock at a lower price. And if the stock doesn't go down, then you would potentially earn the premium that you collected by selling that put. And then the last one being covered calls, which we had spoken about already on this call, and used for many different reasons, but most typically for enhancing the yield of your portfolio.
Tony, much appreciated. Thank you so much for making the time and for the insights today. You've definitely shown us that, investors are trading with intention really at the end of the day and within our portfolios, and that they treat options as part of a bigger plan rather than just a betting game. Thank you for taking the time, and to everyone who joined us today, this is a reminder that if you've got any questions, we're happy to support you and we'd likely have the answers. Thank you for joining us today.
Thank you very much.